George Soros versus Warren Buffett. Whose strategy serves best in a recession? There's a difference between investing during a recession and investing in the anticipation of a recession. When a recession has already begun, one's alternatives are limited. The greatest alternatives are those that can be implemented in advance of a recession. And what better way to ensure that you're on the correct course than to follow in the footsteps of individuals who have survived recessions and emerged even richer? Warren Buffett and George Soros are two of history's most well-known and successful Wall Street personalities. While both individuals have undeniably earned fame in the financial world, their pathways to get there are remarkably different. Buffett adopts a value investing technique in which he seeks out companies that have strong fundamentals. Soros, on the other hand, is a speculative investor who relies on short-term market fluctuations and heavy leveraged investments. One thing that they both have in common is that they've been through several recessions, and in this video, we're going to look at their stories, investment styles, and how exactly those styles worked for them through the recessions. One thing that you can be sure of is that by the end of the video, you'll have an investment style to implement as a hedge against recession. So sit back, relax with your favorite drink, and get ready for a wonderful time. Remember to go clickety-clack on the like button and do a tap dance on the notification bell so that you get notified immediately when we release videos on the channel. Let's get started with our first investor of interest, Warren Buffett. In the fall of 2008, global markets were collapsing. On September 15th that year, Lehman Brothers, an investment bank with $600 billion in assets, filed for bankruptcy protection, signaling a turning point in the economic recession that brought unemployment rates as high as 10%. 2 weeks later, on September 29th, the US stock market lost $1.2 trillion in value when the Dow plunged 778 points, or roughly 7%. Quote, "You just felt like the world was unraveling," a senior equity trader named Ryan Larson told the New York Times that day. People started to sell, and they sold hard. It didn't matter what you had, you sold. However, there was one big investor who had a different perspective: Berkshire Hathaway CEO Warren Buffett. In fact, Buffett was buying. Quote, "I've been buying American stocks," Buffett wrote in an opinion piece for the New York Times on October 16, 2008. During the crisis, Berkshire Hathaway had made significant investments, including backing General Electric and Goldman Sachs. Buffett recognized the gravity of the situation, telling CNBC that year that it was a, quote, "economic Pearl Harbor." So why was he buying equities that were rapidly losing value while everyone else was stuffing cash under their pillows? Quote, "A simple rule dictates my buying. Be fearful when others are greedy, and be greedy when others are fearful," Buffett wrote in the Times. Despite the short-term suffering of the crisis, he believes that the long-term value of innovative American industry will continue to increase. Buffett cautioned readers against investing in, quote, "highly leveraged entities or businesses in weak competitive positions," but advised them to use the slump as an opportunity to buy good companies at reasonable prices. Quote, "In short, bad news is an investor's best friend. It lets you buy a slice of America's future at a markdown price," Buffett told in the op-ed. Fears regarding the long-term prosperity of the nation's many sound companies makes no sense. These businesses will indeed suffer earnings hiccups, as they always have, but most major companies will be setting new profit records 10, 15, and 20 years from now. The forecast was proven correct. The S&P 500 has climbed by 130% in the last 10 years since the collapse of Lehman Brothers. Companies such as Apple and Amazon have reached new heights with trillion-dollar values. According to CNBC calculations, a $1,000 investment in Apple in early August of 2008 would be worth more than $9,222.50 as of August 2, 2018, or more than 9 times as much, including price appreciation but omitting dividends. Buffett's method wasn't perfect. He concedes that his timing on his October recommendation to buy was a little wrong, as markets continued to fall in 2009. Speaking to CNBC, Buffett said, quote, "It was right on a long-term basis, but way off for 4 or 5 months at least." Of course, it's human nature to want to invest when markets are rising, said Buffett in an interview for CNBC's documentary, The Crisis on Wall Street, The Week That Shook the World. Quote, "People start being interested in something because it's going up, not because they understand it or anything else," Buffett said. The guy next door, who they know is dumber than they are, is getting rich and they aren't. Buffett's recommendation, though, is to follow that simple guideline rather than acting on emotional instincts. Quote, "Though markets are generally rational, they occasionally do crazy things," Buffett wrote in his 2018 shareholder letter. Seizing the opportunity then offered does not require a great deal of intelligence, a degree in economics, or familiarity with the Wall Street jargon, such as alpha and beta. What investors then need is an ability to both disregard mob fears or enthusiasms and to focus on a few simple fundamentals. A willingness to look unimaginative for a sustained period, or even to look foolish, is also essential. The Buffett Strategy. Buffett makes strategic purchases. During a slump, he buys millions of shares in solid companies at bargain prices. Buffett avoids investing in technology business because he does not understand their company or industry. During the dot-com boom, he avoided investing in tech companies because he felt they had not been operating long enough to offer sufficient performance history for his purposes. Even in the bear market, despite having billions of dollars in cash to invest, Buffett stated in a 2009 letter to Berkshire Hathaway shareholders that cash retained beyond the bottom would be destroyed by inflation in the recovery. Buffett exclusively works with large companies because he needs to make large investments to generate the returns required to produce good results for his company, Berkshire Hathaway. In a bear market, Buffett's selective contrarian method includes making substantial purchases in blue-chip stocks while their stock price is very low, and Buffett may receive an even better bargain than the average investor. His ability to provide billions of dollars of cash infusion entitles him to special terms and chances that others do not have. His investments are frequently in a type of secured stock with guaranteed dividends and future stock warrants accessible at below market prices. What businesses does Warren Buffett own? Warren Buffett's main investments are Apple, Bank of America, Coca-Cola, and American Express, which he owns through his firm, Berkshire Hathaway. How did Warren Buffett make his money? Warren Buffett did not make his money in one precise technique. Rather, he made it over many years through a variety of steps. Saving from an early age, reinvesting profits, finding a mentor, and living within your means are examples of these processes. Buffett also took ownership of Berkshire Hathaway, a textile manufacturing company that he later turned into a holding company, utilizing it to buy many other companies, allowing him to multiply his wealth. Warren Buffett's strategy, the bottom line. Buffett's approach to dealing with a down market is to view it as a chance to acquire good companies at affordable rates. Buffett has created an investment strategy that has worked for him and Berkshire Hathaway stockholders for a long time. His investment strategy is long-term and selective, with a tight set of standards that must be met before making an investment choice. Buffett also has a sizable financial war chest that he may use to buy millions of shares at a time, creating an ever-present possibility to generate massive gains. George Soros. George Soros, 85, is known as the man who ruined the Bank of England. He is, however, far from a one-trick pony. Forbes estimates his fortune to be $24.5 billion, making him one of the most successful hedge fund managers of all time. He established the Double Eagle Fund with $4 million in cash in the year 1969. 4 years later, it was merged into the Quantum Fund, founded with commodities investor Jim Rogers. The fund returned an average of 20% per year between 1973 and 2011, when it returned all money from outside investors. So, what is his investment strategy? Soros is a global macro investor, which means that he invests in a diverse variety of assets, most notably currencies and government bonds. Soros has his own idea of market reflexivity, which he articulated in The Alchemy of Finance in 1987. The core idea is that market participants' behavior drives markets more than reason, and that this irrationality tends to feed on itself. George Soros is a fan of long-term trades who believes that the market is always wrong. He looks for major market imbalances and trades on them. Among his remarkable strategies are active money management. This method entails monitoring the performance of an investment portfolio and deciding whether to buy, hold, or sell a certain asset. This strategy tries to outperform a certain benchmark while meeting risk management objectives. The George Soros trading approach has a scientific component, as he bases his market moves on scientific methodologies. He employs a strategy in which he forecasts what will happen in the financial market based on current market data. He also puts his theory to the test by making tiny investments first, then expanding the investment if it works. Global macro strategy. He employs the global macro strategy in his hedge fund. This technique entails placing several one-way bets on stock, commodity, and currency price movements. Soros uses this approach to predict whether the value of an investment will decline or rise. He researches his target assets and bases his trades on the movements of financial markets and important participants. He claims that the concept underlying this trade approach is one of reflexivity. According to the reflexivity theory, assets are valued depending on market inputs. Let's take a look at his memorable trades. Soros made at least $1 billion by shorting the pound sterling in September of 1992. As part of the European exchange rate mechanism, the pound was tied to the Dutch mark ERM. But Britain couldn't afford a strong currency, and Soros was well aware of this. He bet against the Bank of England's efforts to prop up the sterling, and the peg eventually failed. Britain broke off from the ERM, and Soros won. He also heavily bet against the Thai baht, another pegged currency soon before the 1997 Asian financial crisis. And although it was a highly profitable trade for Soros, the Malaysian Prime Minister accused him of causing the entire catastrophe. Want to invest like a pro? Here's George Soros' advice for you. If you're just getting started in the world of investing, following George Soros' advice is a wonderful place to start. Here are a few things you can learn from this investment guru. Figure out what works best for you. George Soros does not follow traditional investment guidelines such as long-term horizons or diversification. Instead, he's a well-known speculator who uses large wagers to generate incredible returns. If you want to replicate his success, you must figure out what works for you. It's pointless to strive to be someone you're not. Instead, focus on your abilities, identifying your distinct style and method of operation will allow you to capitalize on your strengths. Look for and capitalize on economic mistakes. Soros bankrupted the Bank of England by capitalizing on an economic blunder. This demonstrates the need to continuously be on the lookout for new chances. One of George Soros' famous quotes is that, quote, "Markets are constantly in a state of uncertainty and flux, and money is made by discounting the obvious and betting on the unexpected." In line with this, you should always look for and bet against economic errors. When everyone else is selling, it may be a good moment to purchase and vice versa. More information on this George Soros trading approach can be found in his book, Soros on Soros, Staying Ahead of the Curve. Don't be afraid to take risks. Many people believe that in order to be successful, you must play things safe. However, as Soros has demonstrated, taking risks can result in the most enormous benefits. He's quoted as saying, quote, "The hardest thing to judge is what level of risk is safe. So even if you're unsure about a deal, don't be scared to take the risk. The profits could be well worth it." Of course, this does not imply that you should make hasty decisions. There's a distinction to be made between strategic and taking excessive risks. Weigh each chance carefully and don't be hesitant to grasp them when they present themselves. Think independently. There's a lot of pressure on investing to conform to the majority. However, as Soros has demonstrated time and time again, sometimes the most profitable investments are those that go against the norm. Swimming against the tide can be challenging, but it's critical to think independently and make judgments based on your own analysis and study. As Soros put it, making an investing choice is like making a scientific hypothesis and putting it to the test. This implies that you should be constantly willing to put your independent ideas to the test and see how they hold up in practice. Prepare to act quickly. Soros is well known for his ability to make swift decisions. Investing opportunities might arise and disappear. Copying Soros' reflexivity mindset is one method to prepare yourself to act rapidly. According to this idea, there's a feedback loop between investors' perceptions and the real world. Being aware of this feedback loop allows you to be better prepared and capitalize on opportunities when they emerge. The Soros lectures at Central European University might teach you more about this ideology. Now, who is richer between George Soros and Warren Buffett? Warren Buffett is by far more wealthy than George Soros. Buffett has a net worth of $124.3 billion as of April 18, 2022, whereas George Soros has a net value of $8.6 billion. The bottom line: Warren Buffett and George Soros will go down in history as two of the world's most talented investors. Despite using fundamentally different investment tactics, both individuals have achieved enormous success in their respective fields. Now it's over to you. What do you think of their investment strategies? Whose do you plan to adopt moving forward? Let us know in the comments section, and thank you for your time. It's great to know that you followed through all the way until the end. Remember to hit that like button and also subscribe to the channel and hit the notification bell so that you're notified whenever we next upload valuable content like this. Until next time, stay inspired.